Welcome everyone. Welcome to the 2022 Wealth webinar. I'm really super excited to do that. I've been wanting to do a webinar like this for a while, and now it is happening. Really, thank you already to all of us for attending. We are lucky that we are a small group, so I allowed everybody to talk so we can make it a bit more interactive. But please, as long as you're not talking, if you can mute yourself so there are no outside noises during the webinar. And also, since I will be sharing my screen, I won't always see when you raise your virtual hand or anything like this. So if you have a question, you can wait a little bit until I make the place for the questions. And if you really have burning questions that you want to discuss really deeply, there will be a Q&A session at the very end, next to the gift that I will give you at the end of the session. All right, so let's get started. So I will start this webinar with a story because I love stories. You're going to hear quite a few stories in this webinar. So let me start with a story. I show you now this picture. That was me in 2014 when I was 17 years old. And I was traveling at that moment with my parents in the US. To be more precise here, I was in Florida and I was absolutely crazed in Florida about the malls because everything in the malls was costing a fraction of what it costed in Switzerland. So I was really crazy about trying to buy the next polo and all of this. And there you see me with this purple polo that I just bought in this mall. And something very peculiar happened in this mall. Something very particular happened when I bought this polo shirt. Something that may sound exaggerated, but really changed my life forever. When I was in the store, I was taking this polo shirt and then I went to try it. And I was very surprised to see that a very old guy, a guy in his late 70s or in his early 80s, was working there in the retail shop. And you could see he was tired and he had trouble to walk and everything, but he was working there in a retail shop. That was really shocking to me because I had never seen, or at least I had never observed such a thing. And I was thinking, this guy has probably fought in World War II. This guy maybe fought in the Korean War or the Vietnam War or whatever. He probably must be a veteran. He worked hard all of his life to provide for his family, and yet there he is in his 80s working retail to survive. And that really opened my eyes because when I saw this, I started seeing other things. And I don't want to kill the atmosphere or whatever, but I've got bad news for you guys. This old guy that I saw working retail and this guy working in Walmart is the fate of most of us, most of our generation. Those who are my age, those who are a little bit older, that's the fate of the majority of the people. I'm not saying that it's the faith of the people in this webinar, but it's the faith of our generation. Because if you do what you learned at school, what school taught you, that you should have good grades, go to college, get a nice job, save, buy a house, diversify, this is the very likely outcome that you will get. But I have good news, it doesn't have to be you. If you apply a few principles that we're going to explore together in this webinar, you can avoid this bad fate to you and to your family. Even if you don't have a family now, your future family. This one thing that can really help you to avoid this and really improve your life in general is one thing. It's called financial literacy. That's what financial literacy can bring you. That's what you can get without financial literacy, but that's what financial literacy can get you. Financial literacy then leads you to financial freedom. So am I saying that the objective for everybody is to just sleep in a hammock and do nothing at the beach? Absolutely not. What I mean by financial literacy and financial freedom is one thing. It gives you options. Financial literacy is about having options. And who here doesn't want to have options? Really? Everybody wants to have options about working when you want to work in what you want to work, being located located wherever you want in the planet. So if you're interested about financial literacy, if you think that it is compelling to you after I told you this, well, let me tell you, you're at the right place, because in this webinar, it will be all about financial literacy. My name is Daniel. I will be your host for this webinar. And I structured this webinar this way. First, we're going to talk about a ticking time bomb that will affect all of us, and we better be prepared for it. Then we're going to talk about dumb money and a couple of myths out there about investing. Then we're going to talk about the principles that can help you to get ahead. And there's the first bonus. We're going to talk about the secret of the wealthy and a little gift at the end for all of you. Consider this as a late Christmas gift from me to you. So a little bit about my background. Some people know me here, some people don't know me that well. I studied economics in Neuchâtel and then wealth management at the University of Geneva. I have some experience in the financial industry and experience investing myself. But before anything else, I am an absolute passionate and absolute obsessed about financial literacy and investing. I really found it fascinating from day one, the art of making money with money, this weird type of alchemy that we can make. And that led me to study and think about certain things that are not common sense. And that is what I want to present to you and share with you in this webinar. So all that being said, let's dive in the first subject, a ticking time bomb. We are facing now a ticking time bomb. It's going to affect all of us. It doesn't matter where you live. It doesn't matter your age. It doesn't matter your financial status. It's going to affect all of us. And it is a financial ticking time bomb. Does anybody here has an idea of what I may be talking about? You can unmute yourself and say what you think.
Absolutely.
What could that be?
Listen, we're gonna live until we're 100 today. That's for sure. And if we stop working at 65, we've got to go 35 years until we retire. The maths don't add up.
Exactly. That's one of the things that is happening to us. That's one of the things that are going to happen to us, and that will have the following consequence. If the slide wants to go forward. There we go. This is the consequence of the ticking time bomb, of what Faisal just said to us. It's this chart. This chart is telling us that our governments are crawling, they're drowning into debt. They're having more and more debt. That is the public debt of the US in percentage of the GDP. Now in 2021, it was 108% of the GDP that was debt for the US government. Our governments, that includes the US, Europe, and a good chunk of Asia, are simply going bankrupt. Why are they going bankrupt? As Faisal said before, retirement is one of the things. We have a big generation now of baby boomers that can be your grandparents or your parents that will be out of the labor force, but they represent a huge chunk of our population. And they will retire, be out of the labor force. And with our current retirement system, all of us, those who are active, will have to pay for their living. And that's certainly not going to happen. The governments are simply going to get into more debt to finance those retirements. Another problem that is happening is the COVID relief package. As you all know here, we suffered a terrible pandemic, and to recover from the lockdowns and all the economics aspects of this pandemic, the governments have decided to issue relief packages. Spend a lot of money, in 2 words. They want to spend a lot of money, and they're going to get even more into debt to do that. And what do the governments do when they run out of money, when they're under debt, and when they're facing bankruptcy? Does somebody know? Or are you shy? Well, the I'm sorry, the governments, when they run out of money, when they're nearing bankruptcy, they do always systematically the same thing. They print money. They have the ability to print money, so why are they not going to do it? And this guy that appeared before time is, you probably don't know this guy, all right? You probably don't know this guy, but he's going to influence your life much more than Justin Bieber or Lady Gaga or Steve Jobs combined. This guy is going to have a huge influence on every one of us. And this
Sai,
guy, yes, Ali?
they won't print money because if they do, the value will go down.
Yeah, that's exactly what I'm going to talk about in a second. So this guy, as I was saying, is the Jerome Powell. This Jerome Powell is in charge of the monetary policy in the US. In other words, that guy is going to decide what it will be the amount of money in the economy of the US, if there's going to be more money or less money. And whatever happens in the US, it happens in the rest of the world with a couple of months lag. So this guy, even if he's the US, he's going to influence your life for better or for worse. And it's happening right now. As we're speaking, the governments are printing money like crazy. And the inevitable consequence of them printing money like crazy is this: inflation. As Ali said, everything is going up. The price of everything is going up. Look at that. The price of beef plus 24%. Used car and trucks plus 26%. Bacon plus 20%. Even the furniture, if you want to buy a sofa, plus 11%. That's the extra price you have to pay to get all of this. And we have seen an inflation that we have never seen in decades and decades. And it's happening right now. And the people who are going to get hurt the most by this inflation are typically people who work for a paycheck, that is employees, that is the vast majority of the people, retiree, anybody who has any kind of fixed income. In short, those who are going to be hit the hardest by this inflation are those who have no financial literacy. Those who are going to be able to
I'm an
survive.
employee who's suffering.
Hmm?
I'm an employee who's suffering financially.
Well, yeah, of course, like if you having an income and everything gets more expensive, you lose your purchasing power. That's unavoidable. That's unavoidable. So what is happening here is that other categories of people are going to go forward despite inflation. Those are entrepreneurs, business owners, investors. In short, all those people who have financial literacy. If you ignore that, if you don't have this financial literacy, you're going to struggle all your life, or at least the next couple of decades, because of that. Exactly because of what is happening right now, of this inflation. But don't worry, because there are some good news out there for you. Some of you might be familiar with that, some of you don't. That's called the cash flow quadrant. This is going to show you how you make money, from where you get your income. So in the upper part here, in the upper left part of the quadrant, we have employees. As I said, the vast majority of the people. Those people have a job. Then we have here the self-employed. Those can be doctors, lawyers. Typically, that's what they are, but not only. They can be, for example, an independent truck driver, independent massage person, or whatever it may be. Those people, they don't have a job, but they own a job. That's the left part of the quadrant. As I said before, those are the people who are going to suffer the most by the ticking time bomb that we're all going to face. Those people on the left part of the quadrant, they work for money. As simple as that. They trade their time and their effort for money. But there are alternatives, hopefully. It's on the right part of the quadrant. Yes?
Trading your time for money, basically, like equivalent exchange.
Yeah, that's what you do. It's an exchange of your time and your effort for money. If you don't work, well, no money is coming in. As simple as that. But on the right part of the quadrant is something very different. We have B, business owners. Those are people who simply, well, the name is self-explanatory. They own a business. They don't have a job. They don't own a job either, but they own a system of people who work for them and that make them money without working. Those are business owners. And being a business owner can be the most rewarding quadrant of this whole cash flow. The potential rewards of being a business owner, the sky is the limit. There are no, it can be completely out of this world, the reward you can have by being a business owner. But it's very difficult. It's very difficult. You need to have a lot of skills, to have a lot of persistence. And this webinar is not really exactly about being a business owner, because that would be being an entrepreneur. That's not exactly the purpose of this webinar. So I want to put your focus on the I part of the quadrant. That is being an investor. An investor is very different from the business owner also because he owns assets. That's everything he does. He owns assets that pay him a living. And the good news is that being an investor must probably be the easiest quadrant in this cash flow quadrant, even easier than being an employee. It's technically very easy. Technically, it's very easy. There are a lot of things that are much harder to be efficient and successful as an investor. It's your mindset. But technically, it's very easy. But I know what some of you are thinking right now. Some of you are thinking, nah, I cannot be an investor. It's too risky. It's too complicated. I didn't go to business school to understand that, to invest myself. I had to hand all my money to a professional who can do it for me because he knows what he's doing, right? That's the thinking of most people. Well, that is a wonderful transition to talk about the second part, this second chapter of the webinar, dumb money. Let's talk about dumb money. Dumb money is a term used in the financial industry. Okay, that's not something that I invented. We're going to see later why they call it that way. But before we really dive in, I would like to tell you another story. It's the story of our friend here, Gordon. Those who watch the movie know who it is. And Gordon is 47 at the moment. He spent 6 years of his life in college. He made an undergraduate degree at Columbia Business School. He was brilliant. Then he got a graduate degree at the Harvard Business School. Again, super brilliant. Now he has 27 years of experience in the financial industry. He has 8 analysts working for him. He's got all the best technology, all the best computers to get all the information you want. And he's managing the money of millions and millions of clients. That's the story of Gordon. Now we've got somebody else and has a different story. I would like to introduce you to Joe. Very different style, isn't it? Well, Joe is also a bit younger. He's 37. He only have high school education. He's a factory worker, but he's very interested about investing. He read a couple of books about investing. He has an investing mentor, and he's got something like $28,000 to invest, and he invests that money. Now comes the question. It's not a story about Joe and Gordon. The real question here is, who do you think will be the most successful investor? Let me know in the comments. Who do you think is
Joe.
the best, Gordon or Joe?
Joe.
Joe? Okay. Anybody votes for Gordon?
No.
No. Okay. Well, I have to say I'm pretty surprised by that. But yeah, you got it right. Joe can be a better investor, despite the fact that Gordon apparently has all the advantages on the planet to be a better investor. He's got the degrees, he's got the cash, he's got the technology, he's got the employees. Everything seems to point out that Gordon is the best investor, but Joe can be just as good as an investor as Gordon. Because think about Gordon for a certain second. He's a professional investor, And you don't imagine how professional investors are really restrained to do what they want to do. They have a lot of restrictions in front of them. They cannot invest in certain stocks because they're too small, too risky, or whatever. They have a list of stocks they can choose from and nothing else. They also have to respond to certain risk management compliances, as we say in the financial industry. He cannot buy too much of this stock because it would be too risky. Gordon has a million restraints. Joe, on the other hand, he's free to do whatever he wants. He has no law working against him or whatever. He's free to do whatever he wants. So we're in a world where dumb money, that would be Joe, hence the term dumb money, as we say in the financial industry, those are people who are not very well educated, who are supposedly don't know what they're doing. Those are the Joes of the world. People call them dumb money. And smart money, those are the Gordons of the world. But we live in a planet where the dumb money is not so dumb and the smart money is not so smart. To illustrate that even more, let me tell you yet another story that is going to be, I think, very interesting to you. One day, the guys at the Wall Street Journal took a monkey. They took that monkey and they blindfolded the monkey. Then they gave darts to the monkey. And they put the Wall Street, on the Wall Street Journal back in the day, they had a list of all the stocks in the New York Stock Exchange. They had a list of all the stocks you could imagine. They put it on the wall, and then they let the monkey throw all the darts on the list. I think it was something like 20 darts, if my memory is right. The monkey threw 20 darts to the list, and then what the guys at the Wall Street Journal did is that they constructed a portfolio with the 20 stocks that was selected by the monkey. But that's not the interesting part of the story. Where it gets really interesting is that they really made this portfolio, and with a little bit of time, they compared how well this portfolio did compared to professionals. And can you believe that the portfolio of the monkey had better performances than the majority of the professional investors? That's reality. I can remember exactly the exact terms. Maybe it was the monkey had better performances than maybe 70 or 80% of professional investors. I don't remember the exact number right now, but I can tell you it was really overwhelming. So what do I mean exactly by this whole story? This whole story goes to show you that no, professional investors are not necessarily better than you are. That goes to show you and to empower you to think that you can do it. You can get your financial literacy and do a better job than most investors, because even if those professional investors have all those degrees and whatever, if they lack certain principles and you have those principles, it's a no-show. There's no way that they can do better than you can do. So that really goes to empower you. Next time you have this inner voice that is telling you, I'm not qualified enough to do my own investments. It's too difficult. It's too risky. I should call a professional. Every time that thought pops up in your mind again, think about the monkey story. Now, maybe some people might be a little bit skeptical about my monkey story. So I'm going to give you some facts and some numbers. So here I should explain to you a little bit. Here we see the amount of finance professionals who did better than the S&P 500 index. The S&P 500 is the 500 largest stocks in the US that we put together and we make an index out of it. It kind of shows you what is the performance of the overall stocks in the US. So that graph shows you that after 1 year, only 39% of finance professionals, the so-called experts, could do better than the S&P 500. 3 years later, it was only 22%. 5 years later, it was only 10%. 10 years later, only 9%. And we can go on. I don't remember right now, after 15 or 20 years, I think it was close to 4, 5%. So that goes to show you that most financial professionals cannot beat the index. So what does that mean for you? It means that you have two options. You can go for the option that everybody tells you, call a professional, hand your money to a professional, or think about the index. Think that you can buy the index with what we call an ETF or a tracker. It's something that you buy and your money is invested in the 500 largest stocks in the US. If you go for this option to buy the index, it's going to be much, much cheaper than the professionals. And you can see the figures there. Most of the time, you're going to do better than the professionals. So if you are somebody who's interested to get into investments and you don't want to give it too much effort and you want to have an easy way out, have an easy way to do it, here you have the proof of what you should do. As the S&P 500. Every month you can put X amount of your money in the S&P 500. Don't think about it anymore. And I can tell you, within the years, you're going to do very, very good. It's a certainty. So here I talked a lot about stocks, but that also applies for crypto, real estate, commodities, bonds, or whatever. So, we talked about a lot of things, didn't we? How many times have we been talking already? Something like 30 minutes. I know I gave you kind of a lot of information. It's a lot of things to digest suddenly, a lot of principles and facts to think about. So now what I can do for you is give you some other principles that now you understood the importance of financial literacy and you understood that being an investor, that's possible for everybody, including you. So now I can tell you a couple of principles, proven principles. Those are not my principles. That's proven principles that are centuries old that can help you to be a good investor, to be good in the I quadrants. So being good in the I quadrant is all about financial literacy, once again. And I will tell you that if you grasp only one single concept about financial literacy, you already did 80% of the work. If you understood this little thing, you already did 80% of what you needed to do, at least 80%. And this principle is extremely simple. It is knowing what is an asset. As I said previously, an investor gets money by owning assets. So it is absolutely crucial to know what is an asset. Well,
sir?
Microphone to you, yeah?
Asset is actually, for example, like buying an apartment, like a flat. So if I buy a flat, this flat is an asset. I can rent it on someone.
Yes, exactly. In that case, it's real estate. It's an asset. It's an asset. Yeah. That's for sure. That's an example. But can somebody come up with another example of what you think is an asset in the comments or with your mic?
It's like when you are investing in something that you don't have to work, but still pays you if you invest in that asset.
Mm-hmm. Exactly. So something that gives you money passively.
Exactly.
Mm-hmm.
You can, for example, invest in crypto that you know that brings you some rendered amount. For example, 40% of your investing thing, you became 40% of that. Or for example, when you are owning real estate without paying with your own money, instead of taking some money from the bank, from other people's money, and then when you invest with other people's money in real estate, then you know that it performs for 2 years or something like that. Then it gives you some cash. And combining with the inflation, it gives you some more money because you can sell it and due to the inflation, you have more money because it has more value.
Exactly. Exactly. So,
Sir,
yes,
it's like our both role model, Robert Kiyosaki. He once
exactly.
said that if you buy an apartment with someone else's money, which is a loan, and then you rent it on someone, and you still make profit, that is also an asset
Exactly. Exactly.
because you're not paying any taxes because you have a loan.
Yeah, that's also one thing. They're not paying any, or very low taxes at least. But we've got something, we've got interesting answers also in the chat. Austin says that an asset equals things that puts money in the pocket. Well, that's on the bullseye. Exactly. I'll come more about that a little bit later. And also, Faisal tells us an asset for me is something that gives me positive cash flow. Something very similar to what Austin said. Very interesting. So now let's give it a formal and definition, something that fits every reality. First, I'm going to start maybe to tell you so that you have a reference point of what is the school definition of an asset. The school definition of an asset, to understand this, we have to know what is a balance sheet and an income statement. In a balance sheet, we see assets and liabilities. Assets, from the school definitions, are everything I own. So that can be, as we said before, an apartment, can be stocks, but also it can be things that don't necessarily put money in my pocket. It can be clothing. This shirt, for example, it's part of my assets. It's in my asset column. This piano that you see, for example, is part of my asset column. This computer I'm using right now for this webinar is also in my asset column from a school perspective. And then we've got the liabilities. That's the money that you owe to other people. So mortgage, loans, other debts. And when we make the difference between assets and liabilities, we've got equity. And that's equity that's super important. That's net worth. Because whenever you talk, you hear that people say that Bill Gates is worth $100 billion, for example. When you hear that, what they're saying actually is that his equity is $100 billion. His net worth is $100 billion. They take all his assets, they subtract all the liabilities, and that's what you get.
Pure income.
Yeah. So
your pure income is your net worth. Like your liquid cash is the one that after you paid all your liabilities or your loans, everything, the clear income is the thing.
Well, here we're talking about the school definition, right? So when we're talking about net worth is what people actually own. It's not necessarily a story of income. If I tell you that Bill Gates is worth $100 billion, okay, but I don't know how much money, how much cash he gets every month or every year. You know what I mean? So that's a story of the income statement that we've got on the right, right? The income statement is going to tell me what is left in my pocket at the end of the month. So we have total revenue, expenses, and then you take the debt servicing. And finally, the investment, you've got the net income. That's the money that is left in my pocket at the left of the month after I paid everything. So that's the school definition of an asset. An asset can really be anything as long as you own it. But now I would like to show you another definition that actually already came up in the comments. It's the Rich Dad definition of an asset, which is different from the school definition. An asset puts money in your pocket consistently. A liability, which is the opposite of an asset, takes money out of your pocket consistently. It's as easy as that. A true asset is going to put money into your pocket. And if you understand that, if you understand the principle, if you're able to make the difference between an asset and a liability, I tell you, you already did 80% of the work when it comes to your financial literacy. If you know that, you're already part of the, well, I don't have statistics to back that up, but you're already in the top 5 or 10% of the population if you know that. It gives you an incredibly unfair advantage. It's so important that I'm going to repeat it once again. An asset puts money in your pocket consistently. A liability takes money out of your pocket consistently. You should know that like the Bible. So how does it work technically? That's what happens when you buy assets that put money into your pocket consistently. That's on the left, the balance sheet that we sell, and on the right, we've got the income statements. So when you buy assets that put money into your pocket consistently, what happens is that here we've got the assets, right? The arrow that goes to the revenue. It gives you more revenue. And since you have more revenue, you have more income. And then you use that income to get even more assets that put money consistently into your pocket. And you repeat the operation again, again, and again. And that is the secret. That's the bottom line. That is how the rich get richer. It's not because the government is nice to them or because we have a right-wing government or because they're evil or whatever. The rich get richer because it's simply what they do. And if you do that, that can be your key to your financial freedom, your key to have so much passive income that you don't need to work ever again in your life. And also something that we talked about before and that we can also use a rich dad definition about is wealth. Remember, before I told you that the school definition of wealth is equity. That is all the assets minus the liabilities. Well, I suggest to you yeah.
Actually, rich means someone who has a lot of money, but wealthy means you don't have to worry about money.
Exactly. Wealth is all about the amount of time that you can spend without the need to work. Wealth is all about the money that you make passively every single month without doing any effort out of it. That is wealth. And you said it very nicely, Ali. Rich people, they earn a lot of money. They are income rich. It's the right parts of this, that what we saw there, rich in the income statement. And that's what the majority of the people, they only think about income statements, but they don't think about balance sheets. And a lot of rich people, they are rich in income, but they are broke and poor in the balance sheets. They're asset poor, they're income rich and asset poor. That's the case of many athletes. For example, many big star football players or even actors or many artists, because they earn so much money because they're so good at what they're doing. They earn so much money in the income statement. But since they don't invest anything of it, they spend it all into lavish houses, expensive cars, expensive travels, and so on, that one day when they stop working, well, the income is away, they don't earn anything. They are penniless again. That's why I don't remember now, it just popped out in my mind, but the majority of NBA or professional NBA players, after they retired, I think it was 60 or 70% are broke. So we're talking about guys who are professional basketball players, and when they retire, the income is gone and they're broke. Imagine that. Imagine how frustrating it must be if you spend your life being rich and one day you're in poverty again because you didn't invest in assets that put money into your pockets consistently. So I know that for some of you, that might be a big realization. That's a big realization that assets, what are true assets, you can now identify what are true assets. But now I want to go a little bit further. I would like to help you in that journey because, okay, you understood that to build wealth, you need to gather assets that put money into your pocket consistently. But there are so many investments out there. There are stocks, there's real estate, and those assets, they contribute to your wealth. They build your wealth in different ways. They achieve your wealth building journey in different ways. So that is why I would like to show you a little invention of mine. And I'm not gonna lie, I'm pretty happy of this. I called it the Wealth Builder Scanner. The Wealth Builder Scanner you will be able to understand what an asset is actually doing to your wealth, how it is contributing to your wealth. And don't worry, you don't have to make any notes or any screenshots or whatever. I'm going to send it all to you via email after the webinar. So you can focus 100%. There are 4 ways that an asset can build your wealth. The first one is cash flow. As we talked previously, you get an asset and it puts money into your pocket consistently every month, every year. It can be real estate, stocks, or whatever. But the thing is, it's cash. It's money at the bank. Then we've got appreciation. That asset is building your wealth because it became more expensive. You bought it at 100, you sell it at 110. So you're $10 richer. As simple as that. Equity increase is particular. It's something reserved only for real estate. Equity increase happens when your equity, as we saw before, increases without you paying for it. You're going to understand it a little bit later when we talk about real estate. And finally, the 4th way that an asset can build your wealth is simply by protecting it. By protecting it from inflation, for example, or economic crisis. Because protecting your wealth is also building your wealth somehow. So now let us see some very popular assets and how they build your wealth so that you understand a little bit better what you might want, what kind of assets you might want to go for depending on your objectives. So we first have stocks, the most glamorous and the most popular investment vehicle, I think. And stocks, they can build your wealth with cash flow. So in the sense that some stocks, they give you what we call a dividend that can come every 3 months, every 6 months, every year. It doesn't really matter, but after a certain period of time, they're going to send you money to your bank account. So in that sense, stocks can build your wealth by cash flow. But I put this little more or less sign because the majority of stocks, they don't give you dividend. So it's not the case for the majority of stocks, especially for high-tech stocks. And finally, we have the appreciation. So that's what stocks do and what most people focus on when they buy stocks. It's simply buy low, sell high. You buy a stock low and you sell it at a higher price. You keep the markup as a benefit. Stocks, on the other hand, do not really increase your equity and doesn't really protect your wealth because if the economy goes down, well, so does stocks usually. And then we've got crypto. Obviously, I had to put crypto there because it has become so popular, right? So crypto can give you cash flow. If you buy a crypto and you do what is called a staking, it's like lending the crypto to a bank and you get an interest. So crypto can give you cash flow, but you have to do the process of staking the Bitcoin and not all coins. It's not possible to do that with all coins. So again, that's why I put the more or less sign. And what most people focus on with crypto is appreciation. Again, just like stocks, buy low, sell high. Crypto do not increase your equity. We cannot really say that they protect your wealth. That might be controversial, but for the moment, they don't. Then we've got real estate, and there you understand why real estate is personally my favorite type of asset, and the favorite type of asset of many people is that it builds your wealth in the 4 possible ways. It gives you cash flow because, as Ali said to us before, you buy an apartment, you rent it, you get the cash flow. You got the appreciation. The price of real estate tends to go up in the long term. You've got equity increase because if you buy the real estate with a mortgage, like most people, right, you're going to pay off this mortgage. And a bigger chunk of your real estate is yours in that case. Your equity increased. Your wealth increased because your equity increased in the house. But you increase your equity without paying for it. Your tenants paid for that equity increase. And finally, we can say that real estate protects your wealth because if inflation kicks in, so does the rents. And if the economy goes bad, well, everybody needs a shelter. So they tend to do very well and to be very stable, even when the economy is crashing down. As always, what I'm saying is not absolute truth, but Those are tendencies. And then finally, we've got gold. Gold is something very appreciated by many people, so I had to put it there also. And gold is pretty controversial because, as you can see, it's not doing anything very well. It's kind of doing things more or less or not doing them. So gold, so here I'm talking if you buy gold and you keep it in your house, gold does not give you cash flow. Of course, if I have a bar of gold right here on my piano, it's not going to give me any cash flow. It's just, well, it's just there. Appreciation, more or less, because unlike stocks or real estate that have a long-term price appreciation, the price of gold fluctuates a lot. In the 80s, it was something, and in the 70s, it was something else. 20 years ago, it was something, but there's not really an upward trend like stocks or real estate. So that is why, again, appreciation, it depends. It doesn't increase your equity. And finally, it more or less protects your wealth because there's a saying, it's a half-truth. It's half true that gold can protect your wealth because when inflation goes up, so does the price of gold, usually. But it's not always like that. It's not always like that. And that's what we have seen, for example, last year where the price of gold went crashing down despite the fact that inflation was going up. So in that case, we cannot say that gold is really reliable for that. So, okay, now you know how to identify a true asset. You know now how to see how an asset is building your wealth. So now I'd like to give you a last principle for that chapter. And to introduce this last principle, I will give you a little bit of an historical context. What you see here is what was called the Maginot Line. It was a fortification line that the French built after the First World War to defend themselves against the Germans. A very long line with fortress, soldiers, tanks, artillery, etc. What they did is that they spread themselves very, very thin. The French tried to be absolutely everywhere. They were spread very thin. That's the Maginot Line. And what happened when Second World War started is that the Germans pierced the Maginot Line with a very concentrated and focused line of tank. They could pierce the Maginot Line and invade France very rapidly. That's the story of the Maginot Line. But there's another story that is the exact opposite of the Maginot Line. It's the story of that man. It's the story of General Patton. General Patton did exactly the opposite than the French and then the Maginot Line. He invaded, he didn't really invade, but he liberated Europe from the Nazis during the Second World War. And what he did was the opposite. He had one thing that the French didn't have. He had focus. And focus is so important because focus is not going to only determine the outcome of the war. Focus can change your life in all aspects. And that also includes your investments. And it's very, very controversial, what I'm going to say right now. It really goes against all the financial wisdom, what they say at university, what financial planners say. It really goes against everybody. But I want to tell you that if you really want to make a big impact, if you really want to, make a lot of money with investments, you need focus. You don't need diversification, like most people tell you. If you hear the common wisdom is that you have to diversify. That's what any financial planner will tell you. Diversify, buy stocks, buy real estate, buy bonds, buy crypto, buy everything. Build a Maginot Line, spread yourself everywhere. Well, that's a very sound advice if you want to get average results. But if you want to get more than average results, you have to drop it. You need focus. You need to choose one asset and become absolutely obsessed about it and think only about it and leave all the rest out. And even within that asset, if you choose stocks, for example, you need an extreme and brutal focus in stocks. For example, you can say, I'm focused only on high tech and I buy only a handful of high tech stocks. That is going to help you and serve you much better than if you spread yourself so thin. So every time you're thinking about diversifying and assuming that you want more than average results, and somebody tells you that you have to diversify or you're thinking about diversify, remember the story of General Patton and the importance of focus. Questions so far? Reactions? Well, we see that we don't have
Sir,
any. Yes?
speaking of stocks, for example, investing in penny stocks like only $10 and lower, is it worth it?
Well, it depends. There are very good penny stocks out there that can really give you a lot of money. It can be a bargain. And there are some of them that don't. And the same way, that goes also for high-tech stocks or growth or value stocks. All that goes to say that there's no one category of stock that is just better. You have to specialize yourself to understand how those stocks work. You can say, for example, I'm specializing in penny stocks, so I can become an expert, so to say, at penny stocks, and I can choose a handful of penny stocks that are going to work for me. It doesn't mean that all penny stocks are good or all penny stocks are bad. It depends. There are good and bad ones. And that's
It's because I did a research about penny stocks and they said that this is for a company that want to scam people, that want to sell its stocks to make up all the money they lost.
well, some penny stocks, I would say, even at a good chunk of penny stocks, yes, that's the reality. That's the reality. But I'm pretty sure also, I'm not a specialist in penny stocks. My thing is real estate. I'm really obsessed about real estate and I think only about that. But so I'm not an expert in penny stocks, but from also my own research on the topic, I think there are legit penny stocks out there, but also a lot of, well, trash and scams. So it's about being able to identify them.
Thank you.
So I see that in the audience, we don't have any financial planner or anything like it, because otherwise he would have screamed at me if I had dared to say such a thing. So that's for the main part of this webinar. Now let's jump on the bonus number 1, the secret of the wealthy. So here we have 3 guys that you probably know, and they all have in common, well, they have a lot of things in common, but one thing that they have in common is that they're very, very wealthy. Does somebody here has any idea of why those gentlemen that we see here, or Elon Musk or Jeff Bezos, are the way they are? Does somebody know why those guys, they are so wealthy in the top 10, in the world's top 10?
Of course, it's because they have own assets during their company, or
Yes, that's true. That's one.
Because they have stocks invested in themselves in their company before she led it to the market.
Mm-hmm. Yeah,
that's my opinion.
Yeah, that's one part of the answer. But some people out there, they have assets, they have a lot of assets, but they're not Warren Buffett or Bill Gates. Those guys, they have a little something extra, a little secret that they use to be a little bit further. We've got a comment here.
Yes.
No, nothing about it. So let me reveal you what is the little secret that they use for that. And thank you very much, Faisal, for being there. He has to jump to another call, and let's catch up. So the thing that all those guys, they have in common, that they do that most people do not do, are 2 things, 2 acronyms. It's OPM and OPT. If I remember well, OPM, that's a topic that came out a little bit before. OPM stands for other people's money, and OPT stands for other people's talents. Those guys, they manage OPM and or OPT. Those guys, they accumulated assets thanks to OPM and thanks to OPT. Because me or you or anybody, yeah, we can get a good chunk of money and become pretty wealthy by saving money ourselves and put it into assets that are going to put money consistently in our pockets. That's true. But those guys, by using OPM or OPT, they get much bigger results much faster. Warren Buffett, for example, since he's on the picture, he's not into the investing business. Warren Buffett is into the insurance business. This guy is the owner of an insurance company. And then he takes all the money from the insurance company because people, they have to pay the premiums, right? And he takes those premiums of the insurance company and he invests all that money. He's investing other people's money. And when you invest in true assets with other people's money, well, your ROI, your return on investment is infinity compared that if you put money on your own. So that's the secret of OPM. And OPT, if you're not an investor or if you're into business, OPT is other people's talents. And that means that you're using the talent of other people, the talent of the experts to build your own business. We come back to the B part of the quadrants. They know that they cannot do everything alone on their own. So they hire people who have the necessary talent to do it. And that's all about OPT and OPM. So if you really want to be in the top 10 one day or in the top 100 of the Forbes list, you will need at some point OPM or OPT.
But sir,
yes?
you said that OPT is a dumb move because dumb money is when you hire someone to invest for you on your behalf.
Yeah. So that's a little bit different. OPT, for example, let's say I want to build a business that is in real estate. Okay. I want to build a house. I want to be in the business of building houses. What a lot of people, they're going to try to do when they're going to build a house, they're going to try to do everything themselves. They're going to try to do everything themselves. But if you use OPT, you hire an architect, you hire a carpenter, you hire somebody to make the roof for you, you hire a plumber. Those are people, architects, doctors, plumbers, and also that have a real talent that can really be used. Professional investors or expert investors, that's another story. They're a separate category. In OPT, you use people who have true talent, who are really talented to do something that you could not do on your own. For example, if I build a house, well, I'm not an architect, I'm not an engineer, so I need one. All right, so there's also another thing that those guys have in common, is that they invested at the very beginning, when they were getting started, they invested very differently. They invested into something that gives you the biggest ROI. And it's not the hottest stock or the hottest crypto or real estate or whatever. The biggest and best investment you can make is into yourself, into developing your skills, developing your, for example, public speaking skills, sales skills, investing skills, copywriting skills, closing skills, etc. So I would like to finish this webinar with this note. Invest first into yourself. Invest into what you have between your two ears because it is your biggest asset. Well, thank you very much for listening. Thank you very much for being there. Do you guys have questions?
I have two.
Yes.
What are the differences between self-employed and business owners? I mean, I know you talked about doctors and business owners, but I
Yep.
mean, self-employed is the same thing as a business owner, don't you think?
Not exactly. Where a self-employed, he owns a job. For example, imagine I'm a doctor and I have my medical
Yeah.
office and I work alone. I'm still trading time for money because I need to work to get the money from my patients, right? If I stop
Uh,
working, the cash doesn't come anymore. If I'm a business owner, let's assume that I own a gas station, for example, to give a very trivial example. In the gas station, I don't need to be present in the gas station to make it work and to give it money to me. That's the difference between self-employed and business owner.
and about the crowdfunding, if I did crowdfunding for my website, will it work? Is it a good thing to do a crowdfunding for business startup?
Oh, yes. Oh, yes. Well, that's a little bit of a different topic, but crowdfunding definitely can be a good idea, and you should explore that possibility for any startup.
But Kickstarter and GoFundMe and Patreon, they don't work in my country. And I let my friend do it for me, but it didn't succeed, even though my friend is an expert in crowdfunding.
Well, I think you should simply try again, try a different way to make it work. I'm sure that in the UAE there must be other crowdfunding platform or uh, going international with international crowdfunding platforms. It could work.
I see.
Yeah.
Okay, thank you.
Anyone
I have
else?
one question.
Yes.
Do you want invest in real estate in Switzerland or USA first?
Um, Good question. I would invest in Switzerland first because it's something that I know well. I know since I've been interested in that for quite a while. I know all the laws and real estate in Switzerland, so I'm kind of sharper in Switzerland. And since I know Switzerland better, I would first invest there, then go in the US, something that I don't know at all. But I think that definitely those are different things. In the Switzerland, if you invest in real estate in Switzerland, you're maybe not gonna get that much cash flow, but you're definitely gonna get an interesting appreciation. Whereas in the US, usually it's the opposite. You don't get that much appreciation. Usually, it depends from place to place, but you get a higher cash flow. So if my objective and I knew the market was really to get cash flow, I would maybe go for the US first.
Oh, okay. It's because in Switzerland you have to pay 200,000 francs to
Yeah.
invest in it. In America, you don't have to have big money to invest in real estate.
Well, that's definitely another thing, right? In the US, the barrier to entry is much lower than in Switzerland. In Switzerland, you need hundreds of thousands of dollars to get started, whereas in the US, with 50 or 40K, it's pretty doable. Yeah.
Okay, thank you.
So in the US, the houses are out of cardboard. That's true also. Usually the quality is not really comparable. So, okay, now I would like to give you the gift that I promised you at the beginning of the video. Thank you again for participating. Thank you again for coming to this webinar. I hope you liked it. I really appreciated all of you coming here. I had some nice surprises, people I didn't expect to come that showed up. I really appreciated it. And I would like to give a special thank you to two people. First, I would like to thank you, Austin, my girlfriend, for being there and supporting me. She was a big inspiration for me to do this webinar because she has done a webinar before me. And if you need a coach or you want to scale your business or whatever, she's the person that you need. Here I give you her Instagram. You should follow her. Great content on IG also. And I would like also to thank Faisal, who had to leave us a bit sooner, unfortunately. Wake Up Mentor in Instagram. I highly recommend you to follow him also. Great content and also very interesting insights when it comes to high-tech stocks investing and real estate investing.